Holy smokers, folks, this ain't no dang jokers. Wow, do we have a lot to get into here today. Okay, CPI numbers obviously came out. I'm going to talk about what's actually going on there with the CPI numbers. Everybody's looking at the stock market like, wait a minute, CPI came in much worse than expected, highest numbers in like 41 years. Why didn't we crash today, right? Why didn't the whole stock market tank? We're going to talk about that as well. We got a lot to get into. I think the only thing higher than the inflation rate right now might be the temperature here in Vegas. Oh my gosh, I went out running yesterday. First off, I left and I was like, it feels like an oven outside, okay? And then I checked the temperature and it was like 111. It said it was going to be 114. Jeez! Hey, remember, okay? If you're planning to come to Vegas, hydrate before you dehydrate, okay? Hydrate before you dehydrate. We learned that here in the desert. You got to hydrate, man, because otherwise you're going to dehydrate. And next thing you know, you're going to be cooked like the stock market, okay? So consumer prices jumped sharply again in June, 9.1% in June. Yes, 9.1%. Just an extraordinary number. Wall Street consensus was in the high eights. So the fact that we came in at 9.1 is worse than expected, not shockingly worse. The shocking number, as I stated before, would be 10% plus. If we had came in with a 10% number, that would have been the shocking number that caused everybody to absolutely flip out in the financial markets, and we would have seen a sell-off of the Dow of probably 1,000 to 1,500 points today, and we would have seen, Bitcoin at 17, 16,000. It just would have been absolute devastation out there. 9.1, bad, worse than expected, but it wasn't the shock and awe number like, we could have had, I guess you can say, okay? Now, in terms of why this happened, quite simply, food was up over 10%, which is just ridiculous, okay? But mainly energy. We're talking about over a 40% increase year over year in energy, which is obviously driven by oil, which is obviously driven by gasoline prices. And obviously, if you go to the gas station ever, the pain at the pump is ridiculous right now. I have friends that to fill up their trucks, their pickup trucks, it's like $200. $175. Let me know if you guys gas up and how much it costs you to gas up, your vehicle, whatever vehicle you drive, and how much it costs. That's incredible numbers. It used to be like if you had to spend $100 to fill up your vehicle, that was a lot, right? Now I know folks paying $200 to fill up their vehicles. Like, that's just extraordinary. By the way, I'm thinking about wrapping the S in a couple of weeks. Let me know if you guys have a color in mind that you think I should wrap that. I want to do something different than the red. But the numbers are extraordinary. That's why inflation is going mad right now, is food and at the end of the day, energy as well. Everything else has gotten more expensive. We know that. But these are the two musts for almost everybody, right? Almost everybody has to gas up because almost everybody doesn't have an EV as of right now, right? Very small percentage of the population has EVs, okay? And food is astronomically high right now. 10% plus, it's just insane, to see food up that much. Food should go up very small amount over time. Just a little bit here, a little bit there. 10% plus double digits? Come on, man. It's out of control, completely out of control. Now, this is creating an interesting dynamic now because the Federal Reserve officials may debate a historic 1 percentage point rate hike later this month after searing inflation report piled pressure on the central bank to act. Everything is in play, Atlanta Fed President Bostic told reporters in Florida on Wednesday. So yeah, everything, okay? They asked him about, raising a full percentage point. He said it would mean everything. So now we're at this point in time, folks, where we could very much be looking at the Fed raising a full percentage point now at this point. And, we haven't seen that in the longest time. Literally, you got to go back to the 80s to see a move that drastic. And so we're at a crazy moment in the market where the Fed's considering actually doing this. And I'll be honest, since we came in at 9% plus, I think they're probably going to do it. Now, in terms of what this does to the economy, it's not good news. It's not good news for the economy. You raise interest rates that much, it's going to hurt business. It's going to hurt everything. Getting an auto loan is going to get much more expensive in a situation where we already have an auto loan bubble popping right now as we speak, right? That's going on. And so now we're talking about a dynamic where, if you want to go get an auto loan, it's going to be much more expensive. Credit cards going to be much more expensive. The interest you're going to have to pay on that. Taking out any sort of debt, even a debt as a company, it's going to get more expensive. This is just what happens if the Fed just keeps raising rates, right? Margin debt for stocks get more expensive if the Fed raises rates. Like, it has such a huge effect on everything debt related when the Fed's raising interest rates like this, right? And not only that, but here's the other dynamic. As we've seen the Fed raise interest rates, you know what else has spiked up? The 10-year Treasury. Now, the 10-year Treasury has recently started to fall a little bit, right? But if I had to guess, I think it might spike back up, especially if the Fed's going to raise 100 basis points. And here's the situation, okay? The 10-year moves mortgage rates, okay? And so the 10-year matters in a significant way for the 30-year mortgage. Now, we already hear about real estate's being in a tough spot. I mean, you look at some of these markets, I mean, they're already starting to get hit hard. It looks like it's just going to get worse. If you're talking about piling on more interest rate hikes, and you're talking about the 30-year going to 6.5%, 7%, which is definitely a realistic possibility on average by the end of the summer, who's going to be out there buying houses at a average 30-year of 7%? I just don't see it happening. And so I think we're going to be in a situation where it's going to be, the real estate market is going to get very, very ugly, very, very quickly. And we're already starting to see it play out in the numbers, but I think over the next few months, it's going to get way worse. And I just don't see any way you can be bullish on real estate for 2022. I mean, maybe 2023, but I don't even think 2023. I mean, I think, we might have to push out to 2024 for real estate. Now, this is obviously more bad news, okay? The United States personal savings rate has dropped to just hovering a little above 5 right now at this point in time, which is very, very low on a historical, average. So here we are in this moment in time where personal savings is down huge, inflation slicing and dicing people. Simultaneously, you have the Fed making all debt much more expensive with all these interest rate hikes. And you can understand why there's a lot of recession fears out there. Like, it makes sense. Everything's getting more expensive. Debt's much more expensive, right? And going to get more expensive here over the next 30 days, I can tell you that much. And people's savings are at pretty low numbers right now. This is why there's so many recession fears right now. And it makes a lot of dang sense, honestly. It makes a lot of dang sense. Now, the only thing not feeling some inflation is stocks and Bitcoin. I mean, stocks and crypto, it's like, if you own either one of those, you're like, come on, man, can we get some of that inflation over here, man? Only thing we got is deflation going on in our markets. Man, oh man, okay? Now, everybody wants to know, what the heck stock market, okay? The Dow was down about 200 points today. The S&P 500 was down 0.45%. The NASDAQ was down 0.15%. And the Russell was down 0.12%. So everybody's looking at this, they're like, oh my gosh, okay, highest inflation since 1981. They're saying, obviously the inflation was worse than expected. And so like, why did we not tank this market here today, okay? And I want to show you guys a lot here in just a moment, a lot of different slides that I prepared for you. But I'll tell you the core reason why the stock market didn't have a massive sell-off today. And to put it quite simply, a lot of this was already priced in. And the way most of Wall Street's looking at this is the peak in terms of the rate of increase. So every single person possibly on Wall Street is expecting the July number to be lower than the June number was. So essentially, almost everybody is expecting us to go down to the 8s, maybe even lower than that for the July numbers. And I'll show you exactly in detail why that's the expectation. So being that we're at the worst it's going to get, or at least that's the view of Wall Street now in terms of the rate of increase, they say, okay, the story's already reached its climax in terms of the bad part. Now, in terms of inflation, at least, maybe not in terms of the economy, but in terms of inflation, the story's going to get better and better and better. And we can slowly start to remove that piece of the wall of worry, which is inflation. Now, if you remove that, you're still going to have recession fears. You still got, obviously, Russia, Ukraine, you still got a lot of stuff to deal with in the wall of worry. But if the worst of this is behind us now, right? And those numbers will start coming down over the coming months. Then we've removed a brick of the wall of worry, right? And so that's the way Wall Street looks at it. And so that's why this stock market was not down massively today and we didn't tank through the floor or something like that. Here's the deal, okay? First off, the comps, these inflation numbers are having to start to comp against year over year is ridiculous. I mean, we're talking about 5.4, 5.3, 5.4% numbers over the next few months. And then once we get into the fall and winter time, you got to comp against these numbers of 6 to 8+%. And so we're in this dynamic now where the comps get so much easier to comp against year over year because they had already gone so insane, right? And so in this situation, I mean, it's going to be hard to comp year over year and show another 9% increase. It's not impossible, but if you're going to talk about, let's assume we had still 9% inflation at this time next year for CPI. That would mean a situation where oil had to go dramatically higher from here. Rents had to go dramatically higher from here. Food prices had to go dramatically higher from here, right? I think it's a hard situation to kind of see play out, especially when you're in a dynamic where you're likely either in recession or you're very, very close to going in recession, right? And so that's the way a lot of Wall Street's looking at this. Also, the way Wall Street's looking at this is we've already peaked in terms of gas prices in the month of June, right? At over $5 a gallon for unleaded. That peaked June 14th. Diesel peaked June 19th there. Since then, obviously, we've come down a decent amount. We still got more to go, right? $4.63 is the average as of today. Diesel $5.61, okay? So what everybody's looking at is they're like, gas prices have already peaked. We're already past July 4th weekend now at this point, which is obviously a huge travel holiday. And so most folks are expecting, if anything, oil prices to continue to moderate, or continue to downtrend, which is what they've been doing, which means the whole energy cycle, gets in a better place, and we don't have to deal with, energy just going through the roof 40% plus. And maybe it comes down to 30% and then 20% and then 10%. And who knows, maybe at this time next year, we could be looking at a situation where oil's actually below where we're at. So we could potentially, keyword is potentially, have deflation going on in the energy market, especially if we're in recession at that time, or we're let's say we already came out of the recession, but it's like slowly coming out. You could actually be looking at deflationary numbers when it comes to energy at that point in time. So that's the way Wall Street's looking at all this, and they're kind of judging this, right? Now, if you look at kind of WTI, this usually lags a bit. For instance, we reached peak WTI on June 7th, but then we ended up peaking in terms of gas station prices on June 14th, right? So that was a week lag there. So you got to understand, like, you're usually going to have a lag between what the gas stations are charging and essentially like what oil is doing. So if anything, oil, as long as oil doesn't spike up like crazy over the next few weeks, you're going to likely see gas station prices come down more and more and more over the coming weeks as they compete, right? And then this gas station decides, okay, we're going to lower price a little bit. And then they, because you've got to stay competitive out there. I came from the gas station market. I know how that is, right? And there's always a 1 to 3 week lag in there. And so likely, if anything, gas station prices are going to get better over the next few weeks. And so that's good news for everybody outside of some major epic spike in crude oil or something like that. Now, VIX, VIX went down today. There's no volatility in this market. I mean, I don't want to say there's no volatility. Because at 26, 27 is still fairly elevated for an average market. But you're not getting that insane epic moves. And people are looking at VIX and they're like, come on, man, spike up. We want to see that capitulation type VIX. And it's just like, you're not going to get capitulation type VIX with inflation coming in a little worse than expected. You're just not going to get that sort of move, especially when you already got a NASDAQ that's down 30% from highs, and you got a Russell that's already down 30% from highs, and we're already in a bear market in the stock market. In order to get VIX to spike to a 40-50 level, you have to get a panic situation. You have to get a shock and awe event. That's the only way you get that, okay? Rona was a shock and awe event. Oh, all of a sudden it was like normal economy, and then all of a sudden it was like, oh, we're going to close down the economy for 3 years that we're talking about, right? That's a shock and awe event. Obviously, the Great Recession, when some of the biggest investment banks failed, right? And you had the AIG situation, Lehman Brothers, and all of those. When you had all that going on, it was a shock and awe event. Investment banks, Wall Street banks were going down, that people just couldn't even fathom these going under, right? There was a shock and awe event. So in order to get this VIX that everybody wants to see of 45, 50, 55, you've got to have a shock and awe event. And if you don't get that event, we're not going to see the VIX spike up like some people wish it would spike up. And you don't need it to spike up like that to bottom out the market. If it happens, it happens, but you don't need that to necessarily happen. You can have the market downdraft and VIX kind of be in a chill state nonetheless, okay? Now, while I was recording the video, I had CNBC on in the background, and Josh Brown pointed out this. He says, they had studied every recession since World War II, and every single time, you get a triple digit return 5 years later from the lows of that recession, wherever the stock market was, which just is very, very telling to kind of understand, like, man, you gotta buy in these sorts of markets at the end of the day. Like, you've got to buy, like, the returns you get are absolutely astronomically high. And I think that's just one of those things to keep in the back of your mind when you're going through a bear market, when you're going through recession and the wall of worry and things like that, is to keep things like this in mind and understand, like, what's really going on here, right? I pulled up this, and this just shows you obviously what the stock market's done over time, and all these little gray bars there, those are all recessions, okay? Every single gray bar is a recession. And one thing we do know is, gosh, every single recession should have been a buyer, right? Every single one of these opportunities throughout all of time, like, you should have been a buyer. You should have been a buyer. You should have been a buyer. And to not have been buying during these recessions, during these stock market crashes, is just a massive, massive mistake. The second worst decision you can make in the stock market, in a recessionary scenario, a bear market, whatever you want to call it, and usually bear markets and recessions kind of go together, right? The second worst decision you can make is sitting on your hands and not doing anything. Now, some people feel comfortable by just sitting on their hands, and they say things like, I'll invest again when the coast is clear, they say, okay? I'll invest again when I feel like the economy is in a good place again. I'll invest again when a certain political party is in office, right, in the White House. I'll invest again when, there's not so much fear in the market. And you can do that. It's just the second worst mistake you can usually make in the stock market, is sitting on your hands and not deploying capital into a bear market and into a recessionary market. It's some short-term pain and some short-term scariness for a whole lot of long-term gain in the end. But that's the second worst, decision a person can make in the stock market during this sort of time. The absolute worst decision somebody can make is selling during a crashing market and selling during a recession, right? I mean, imagine selling during all these different time periods, right? And you sell and you sell and you sell, like, geez. I mean, just, it doesn't get worse than that. Like, literally, like, and unfortunately, in every single one of these scenarios, how do you think the market goes down like that? Let's ask that. How do you get the stock market to go down 20, 30, 40, 50%? The only way you get that is through mass selling, right? People panicking, freaking out. I want to get out. Let me sell. That's how you get that. You get this overwhelming amount of selling pressure, and that's how the market can tank, 20, 30, 40, 50%, right? And so in every single one of those situations, people chose to sell. And it's literally the worst decision you could possibly make. And you're missing out on so much long-term gain, all to sit on the sideline and be like, I'm not going through the pain they're going through now. Whew, I took my loss and I got out of there, okay? And it's just like, oh, gosh, man, that's the absolute worst decision you could possibly make. And I don't know how many of you guys have kids out there, but, obviously I have 3 kids, and one I'm teaching to how to ride a bike without, training wheels on right now, and the other one I already taught, a few years ago. But it reminds me a little bit of teaching a kid how to ride a bike without training wheels, because kids, for the most part, are a little scared, as they should be, without the training wheels, right? Because they're going to fall over, they're going to get hurt, they're going to scrape their elbow, whatever, right? And so they're scared. But you got to kind of understand, you got to explain to them, like, hey, once you get this down, it is going to be so much fun. This is going to be so fun for you. Like, you're going to love riding your bike around, and, you're going to have years and years of fun ahead of yourself learning how to ride this bike. You just got to get through this part of, like, learning, and you're going to fall down a few times. You got to get them to understand that, right? And the same exact thing goes for adults in the stock market. Adults in the stock market look at it and they're like, oh man, I don't know if I want to scrape my elbow and, burn my knee here. And it's like, dude, you have so much long-term fun ahead of yourself if you can just get through this time period of the scrapes and falling off your bike and, dusting yourself off. Dude, there's so much long-term fun in front of you. But, and you can even go back in history and, like, show every single one of these times, document it. And, like, listen, you had to get through this short-term pain. Yeah, the market went down, ... But gosh, if you were just buying and holding during this time period, you had years of fun ahead of yourself, right? And so, That's just kind of my view on the market, and yeah, it's just you got to take advantage of the deals out there, despite all the worries out there. So, hope you guys enjoyed today's video. As always, I appreciate you guys joining me. If you're looking to actually access, I made a couple courses free. One's a more a beginner course, and one's a little more of an advanced course. I made both of those free right now. If you want to book a 15-minute call with somebody from my team, they'll basically take you through, ask you a bunch of questions on what course is the right fit for you, put you in that course absolutely free. You don't have to join my private stock group to get access to that, and I hope you enjoy that. It's pinned comment. Much love as always, and have a great day.